Good morning, ladies and gentlemen. Happy Saturday to you all. I hope you're having a wonderful start to your weekend. We're going to be covering the S&P 500, the news catalyst for the week, along with the biggest winners and losers, giving you out the key levels that are very important for the market that we have to watch next week, along with, at the very end, we're going to be going over our own personal thoughts on the market, covering various topics. All of those will be linked down in the description below, timestamps, so you can skip around to whatever part of the video you most want to see. And if you guys wouldn't mind, if you are finding yourself enjoying the content throughout the video, please hit the like button. It really helps out the YouTube algorithm. This is the only time we're going to be asking about that. And if you find some value with this analysis, please consider subscribing to the channel. We do daily videos, fundamental and technical analysis to give you each flavor of the market. And a weekend deep dive, we stream the CPI number days. So a lot of content that we tried to tailor to our viewers. We also do a viewer requested ticker Friday that through the week we collect all our viewers requested tickers and then go over them on Friday. So it's just kind of giving back to you guys on Friday. So without further ado, let's dive into the video. So quick recap, just not tuning our own horns, but we did cover this 380.65 level on the last weekend deep dive. We actually said 380.64. We missed it by 1 cent, guys, but you always front run your targets. So bounced off that key level, came up to the 200 daily moving average, broke back above it, closed, and then gap down below, filled the gap that you created previously from the day's selling, and then powered up on Thursday to only then give up most of those gains on Friday. So it was a topsy-turvy kangaroo week. And that's going to be the key for this video, guys, is that this was a kangaroo market. We've talked about this over and over again on the channel, that when we're below all the moving averages, it's a very clear picture. When you're above all the moving averages, it's a very clear picture. When in this forsaken market of this kangaroo that's bouncing between all these moving averages, it is just very difficult to trade. I took a humbling this week, and it wasn't pleasant, but you're going to have those weeks that you take a humbling. I had good trades, then I had my bank play completely blow itself out of proportion, took a nice $600 loss on that, which equates to about 1% or 2% roughly. But I had some bullish trades that I took that worked out in my favor short term. So overall, I'm down $400 on the week, but it could have been much, much worse. I'm green on the year, so better than the S&P 500 at this point. So that's our goal for this channel, is always to beat the S&P 500. And with that, let's dive into the news catalyst that gave us this crazy kangaroo for the week. So if we look at Sunday, we rarely have Fed events on Sunday, but due to the SVB bank debacle, we had the Fed coming out basically saying they're going to hold an emergency meeting over the weekend, Yellen coming out, all this. You had President Biden speaking on Monday, but really just reaffirming kind of what Fed Powell and Yellen said, along with then you had the core PCI numbers come out. We did cover this in the live stream on CPI on Tuesday. We usually stream it around 7 o'clock on the day of CPI, just giving you the market carnage recap along with the numbers, going over our own thoughts. So if you guys wouldn't mind, it's linked down in the description below. Go check it out. See what your thoughts are on that. High level recap of that. We basically went over why we think these numbers are cooked, gave you some evidence to that, because you weren't living under a rock and you go to a grocery store, you would notice that numbers are just keep going up. There's no relief in prices for that. So that's why we were saying this number is cooked. But regardless if we think it's cooked, regardless if we think it's false, this is what the market reacts to. So it had a very interesting reaction to it, where you had the CPI number come out and the market kind of just said, okay, we'll rally. But then all the banking scares just kind of really, it took hold of the market, giving them 2008 vibes. So just quick recap, the only one that beat expectations was core CPI, came in at a 0.1 more than the market was expecting, which is kind of being a trend right now, where all the numbers the monthly numbers on cores always coming in higher than expected. Just my own personal thoughts on that. We had Bowman speaking, but they just really talked about the banking scares. Then you had core PPI come in better than expected, significantly better than expected. My own personal thoughts on this is the numbers were cooked like no tomorrow. Also, if we believe this number, so let's put ourselves in the camp that we believe these numbers. Personally, I don't. That's just my bias. Is it because that prices are decreasing due to vendors and companies being able to get those goods at a better price because there's so much demand that they have to sell them? Or is it because there's demand destruction that basically prevents them from selling it at a higher price, so they're taking a loss. They're basically showing a shrinkage of the economy where you have demand destruction. Just some food for thought. We'll give you some more deep thoughts on this in the debate section of this video. Timestamp down below. And then we had retail sale come in lower than expected, so adding to that shrinking of the economy. And then we had building permits coming in on Thursday, better than expected, which I've personally seen this. I live in a community that basically has new buildings coming up, and I have seen personally an increase in building starts recently as rates have started to kind of nosedive, where it makes it easier for the consumer to get a loan and kind of stabilize out. So it was very fascinating to see this number come out. It's just something I found of interest. Philly Manufacturing Index shrunk again, adding to the credence that the economy is shrinking. You're not having an increase in the economy. And then we had capital utilization come in worse than expected. Definitely something to pay attention to then. And also, we cover this a lot on the channel, is the net speculative positions on the S&P 500. So we're going to dive into that quickly. So if we look at historically, they did take some positions off, which is naturally you want us to start taking profit, but it's still very, 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 very bearish. The January 27th is when they were at last of this level. So we dive over to the chart just to see where we were on January 27th. We were nearing probably the top of the market. January 27th, we were here right at 404 on the market. So you see we're significantly below, and they haven't taken off their short positions yet as much as they were before. So you may be seeing a more bearish tone in the market. But with that, guys, we're going to dive into the biggest winners and losers of the week. So my partner is going to take it away from here. All right, guys. So
thank you so much for that, boy. Now let's actually come over here, guys, and figure out what in the world happened in the markets this week, because it was absolute insanity, right? I mean, SVB last week, also a little bit of this week. Then we had FRC just completely go like crazy. And on top of that, we also had fears of Credit Suisse going under as well. We got ECB also saying, that they're raising interest rates. It's just absolute insanity. So as you guys can clearly see, on the week, on the 5-day, this thing went actually up 2.69%. On the day, guys, as if I'm recording this, it is Friday. In the day, this thing went down 1.1%. So pretty... yeah, it was just very volatile throughout the entire week. I mean, you guys are seeing this graph here on the 5-day, spike up, spike down, spike up, spike down. It's just massive all over the place. But it's funny because, like, even though we are 3,916 points here on the S&P 500, guys, the funny thing about this is that we have been lower. In fact, if we actually take a look at this, guys, on the 1 year, we can see that we are actually down only 11.22. And at one point, guys, we were down to 3,580 points. So as you can clearly see, like, even though this feels, for some reason, this drop that we've had this week feels a lot, it actually isn't in the grand scheme of things. So just keep that in mind. Now let's actually come over here into the S&P 500 heat map to see what we can actually learn, which companies did the best, which companies did the worst. And wow, does this thing look mixed. Let's start off with the technology sector. A sea of green, except for the information technology industry. Everything here was red. However, though, the biggest loser out of all of them, guys, would have to be the company Enphase Energy, losing 12.64%. And the biggest gainer, I kid you not, guys, was none other than AMD, gaining 18.35%. Coming into the communications services, we got a lot of green here, only with a few reds. By the looks of it, guys, the biggest gainer would actually have to be Google, gaining 12.58%. And the biggest loser would actually have to be, guys, Dish, losing 13.58%. Looking at the consumer cyclicals, very, very red sector. In fact, it was very red, especially right over here, and like the travel cyclicals and that kind of stuff. Wow, very, very red. Now, the biggest loser, from what I could see, guys, would actually have to be the company CCL, Carnival Corporation, losing 11.77%. And the biggest gainer, by the looks of it, is actually none other than Amazon, gaining 9.06%. Looking now at the consumer defensives, very, very, well, it has its greens, it has its reds, but it's kind of 50-50, honestly. By the looks of it, the biggest loser would be this company over here, which is Newell Brands, losing almost 7%. And the biggest gainer would be Procter and Gamble gaining 4.2%. And now coming into none other than the financial sector. Now, if you guys have been around this past week, well, you know what's been happening when it comes to this. And it's not a surprise that it is a lot of red around here, specifically in the banks diversified. This is looking atrocious over here, all because of, first of all, SVB, and then Signature, and then Credit Suisse, and then just everything else. So it's just been crazy. A lot of people are calling that this is the collapse of the banking system. So not surprising that this is all in the red. Now, believe it or not, the worst one is actually not any of the banks. It's actually Zion Bank Corporation National Association losing 25.8. Now, we still have over here SVIB, which is SVB, the one that went to zero, and also Signature Bank. But these guys should be delisted by now. But the ones that aren't delisted, well, definitely the worst one would actually have to be... actually, no, I am so terribly sorry. Take a look at this. First Republic Bank, guys, on the week, 71.83%. Absolute insanity. This regional banks has just been getting crushed, absolutely crushed. And the biggest gainer from what it's looking like would actually have to be Market Access Holdings, MKTX, gaining 12.41%. Looking now at the healthcare, very, very green sector. Wow. That is actually really surprising. From what it's looking like, the worst performer would be this company over here, CRL, Charles River Laboratories International, losing 4.75%. And the biggest gainer would be ILMN, Illumina, gaining 15.74%. Looking now at the industrials, a lot of red here, guys. Only a few green ones, and in fact, it actually ended up being just UPS and FedEx, the ones that pretty much dragged everything up. Actually, waste management as well. Very, very interesting. But nonetheless, the worst performer in this sector is the company United Airlines, losing 15.56%, and the biggest gainer it is FedEx, gaining 9.5%. Looking now into the real estate sector, a lot of red here, though. We do have a massive green right up here. Oh my god, that's absolutely crazy. By the looks of it, the worst performer it is Boston Properties, BXP, losing 11.04%, and the biggest gainer by the looks of it, it is SBAC, gaining 6.61%. Looking now into the utilities, a really, really green sector overall this past week. Absolute insanity. The worst performer is actually just AES, losing 3.75%. And the biggest gainer, it is, I believe, from what it's looking like, I believe it is the company WEC, which gained 7.63%. Coming now into the energy sector, it's just been getting destroyed. Like, this thing has just been getting more destroyed than that of like the banking sector, which is just absolutely insane. You can see everything here is massively, massively red, but the best performer out of all of them would be none other than, would actually be the company Williams Companies, only losing 2.08%. And the worst performer would be the company, by the looks of it, Halliburton Company, losing 13.26%. And lastly, coming into now the basic materials, a lot of red here too. We only had two green ones, honestly. And the worst performer would be, by the looks of it, it is this company, STLD. I think I named them last time, Steel Dynamics, losing 13.67%. And the biggest gainer is actually Newmont Corporation, gaining 14.26%. All in all, guys, the markets this week have just been insanely volatile, mainly because of the banks, as well as oil too. So, you know, tech is just ripping it right now, but at the same time, we have a lot of news coming up tomorrow, especially when it comes to the Federal Reserve FOMC meeting. We'll see what they actually decide to do with the raising of the interest rates, or is the pause coming? So be on the lookout for that one on Wednesday, and that will pretty much do it for my part. Take it away, Mike.
All right, guys, so now we're going to dive into the key levels of the chart, and I'm going to walk you through this, how to get these levels. This is what I do for the key levels of the chart. It's pretty freaking simplistic. So the first levels of sending up support and resistance, we always look at the weekly highs and lows. So whenever you have a candle that has a lot of wicks, you always go, you put a line at the bottom of the wick, you put a line at the top wick, or kind of move it around to basically coincide with a significant candle. So around the 396 to 380 level, those are your two levels that you have to basically pay attention to, that we need to pay very, very close attention during the week of the next trading week. So if we look at the S&P 500, just to get more price definition, I put a level at this 394.40 level, which is our 50 weekly moving average. I'm going to move that down just slightly, just so it coincides with the price that we had this week. So 394.40 is right where we're magnetized to that upper wick where we broke slightly above the 50 weekly moving average and then broke down below. So I'm going to highlight this area right here of importance. I'm going to say importance because it is our 200 weekly, which has been a very strong pivoting point that we have to pay attention to. We're going to highlight that as a white line, so we pay attention to it during the week. This will give us an indication of almost a pivot point. So if we're trading towards it, we may be looking at higher targets. If we're trading below it, we're looking at lower targets. So first important target is 383.71, which was our pivot point right before this push up right here. We rejected off this trend line that goes back to from our October low to the January consolidation and then basically to this trend line. So I personally thought, on a personal note, that we were going to break this trend line with this bear squeeze rally going up. I thought we had the ability to start tackling this 400 price zone, but I was thoroughly wrong. We gapped down, we rejected off the 50 weekly moving average, and then basically went lower during the day, broke below the 200 daily moving average, and now closed below that. So now we have one close. We need to see Monday's close below this to be truly bearish, and then we're going to also have to look at the NASDAQ just to see where we are as a whole. So bullish areas that we need to be looking for. Possible bounce point, 383.71. We need to, that's a white line just because it is a key pivot point, so it's not necessarily support, but you have to be careful of what happens in that region. If we break through below it, start coming back above it, definitely I'd be looking for that rotation up. Next, 380.65. If you break this point, we're basically going lower. Then we're going to start attacking these areas of the 377.75 level. So that would probably be a nice short position here from there to there, about 0.75. So definitely something to be on the lookout for. Now, here's where I find it very peculiar and possibly interesting. So you had increased volume and you basically kind of, if we look at the start of the week to the end of the week, you only really moved about 1%. If we look at the weekly, you had a gap down, push up, rejection, wick. So you had a failed breakdown, but you also didn't break out anywhere. So you're still within the body of this candle. So we definitely could see a consolidation in this period into Wednesday. I wouldn't be too surprised. And then a sharp move afterwards because if the Fed ignites a rally to the upside or downside, it will probably continue. Also, you are kind of coiling in this area where if you actually look to see how much volume has transacted, and I'm going to take we're going to make it a purple line to where we are now. We're going to make it nice and fat and a purple line. Look how much volume has transacted around this region. It's technically a gigantic coil winding up around this 390 region that once it unwinds, it's going to be absolutely massive. And I can't give you a direction because we're in the Kangaro. I can only give you the key levels and that 390 pivot that basically is super, super important. It also coincides with our 200 daily moving average. So we have to be very cautious about that. Also, if we look at it as a whole, you just looking at it, I can't really tell you because you get a risk to reward ratio of about the same because you have key resistance levels up here, support down here. It's about a 1-to-1 ratio. And I really don't like trading in 1-to-1 ratios because how do you get ahead in the market? You have an unfair advantage. And until we break or have a decisive move outside of this range, I think we're just going to go sideways. I think there's a lot of premium that the market makers want to burn. They kept it right at 390. That's where they decided that they wanted to. It was quad witching. So a lot of premium got burned. And I'm sure that everyone's, going to give you the, it has to go up, it has to go down argument. You're in a Kangaro. I really can't make that argument of upside or downside. I'm humbled this week where I got burned. I'm basically saying I'm not trading for the next 3 days because number one, I'm going to make mistakes. I'm going to try revenge trading because it's a natural human response. And until I see a significant move out of this area, why do I want to work for my money? I want my money to work for me. Shorting up in this region was the easiest trade ever. We just shorted it down, broke down, took advantage of the banking scandal. But I think Marco's kind of destined to come down to this 200 daily moving average. That's what I was targeting. Quickly, we're going to give you the recap of the key levels for the S&P. 394.40, 396.11 is your key resistance points. Once you break above that, then look higher. Next, if we break below 383.71, targeting 380.65 as a possible bounce point or reversal. If we break that, targeting 377.75 as secondary target for shorts. And if we do not get that bounce, if we start breaking the 375 level, I'm going to say we could be expecting to come down to our 200 weekly moving average, which is sitting at 362.79. Once you start breaking the 380 level, then you definitely have to be more bearish skewed. And if you break the 396 level on the S&P, then you have to be more bullish skewed. So let's jump over to the NASDAQ real quick. I really want to show you guys something on the weekly. So on the weekly, this has never happened in history to any index. And I know that's a bold statement, but I really challenge you to go back and find a weekly bearish engulfing, bullish engulfing, bearish engulfing, and bullish engulfing of the same weeks in a row. You've never had a triple engulfing on the NASDAQ. And it's really, really bearish because in order to have a engulfing candle, you have to make a larger range. You have to engulf the entire range. You're creating a broadening wedge, which for all those that don't know what a broadening wedge is, it's a very, very bearish pattern because you have to break this constantly moving upward trend line, and then you usually come back down and break through the bottom trend line. So for the NASDAQ, you do have some bullish signs on the chart, and I could see where you could break above this 309 level, which comes back to our pivot point back off the September highs. I definitely could see greater price appreciation to be breaking this trend, invalidating this wedge, and then going higher. You do have the short-term price basically moving over the long-term price, so it's a bullish cross. So we have to pay attention to those things. So for the NASDAQ, let's jump over to the weekly. The key levels, I'm going to say, is we're going to highlight two levels as important, and that's going to be the areas of previous breakouts that we basically had, where we had a failed break down and then a failed break up. So those levels are going to be very important for us during the week. Then we're going to highlight our resistance levels, which is going to be the 309.15 level, which is the weekly high, and then 285.19 as our support for the week. Next, let's dive into the daily just to see where we could establish different things on that. On the daily, we basically have our key levels established. So based on NASDAQ being up so high, once we start breaking the 304 level, I would definitely be looking more bearish skewed just because you don't have a lot of price action in this region right here. So it would be very easy for the NASDAQ to start falling, especially with a lot of tech companies leading this rally. However, all this analysis is subject to change after the FOMC meeting because Powell could ignite a massive short squeeze, or you could ignite a massive sell-off. So you really have to be very careful of which side you position on. Like again, I played the bank stocks, I lost money, but I positioned very small, so my risk to reward was very small. It didn't impact my portfolio as a whole, and I'm staying very liquid into the FOMC meeting. If we come back down to this 293 level where we have the convergence of the moving averages and start breaking through it, then I'd be definitely looking to retest that 200 daily moving average depending on the close. However, we have to pay attention to this area as a very large pivot point that could be a bullish pivot or a bearish pivot. So definitely key level to look out there. And your support levels for the NASDAQ are going to be that 285 level. If you start breaking the 285 level, next stop 282.72, which is our 200 weekly moving average. And then if we have a break of the 200 weekly moving average, then I'd be looking very, very bearish on the NASDAQ, probably reclaiming this long-term downtrend as our next support, and even possibly coming down to this 260 level because it would basically be the sign of a very bearish trend forming. So with that, guys, we're going to dive into the VIX, dollar, and yields. First, VIX. So VIX has actually been trending above its 200 weekly moving average, which basically signifies a consolidation in this area. It's consolidating between the 22 and 20 $7 level. You could almost think of this as a coil winding up. So what happens when coils are released? They blow up to the upside or they blow to the downside. So with VIX being elevated here, you have a 50-50 split of where it can go. So if it blows to the upside, you're probably going to break through 30, and you have the possibility of starting to tackle this 40 level area where basically things start breaking severely. It's really going to come down to the FOMC and what Powell says, their terminal rate, and more importantly, what the future rate hike path looks like. Next, we're going to look at the dollar. The dollar basically looks like it crash landed on the 50 daily moving average and basically kind of consolidated in that region, pushed off of it, got rejected off previous resistance, and then heading lower. So we have to see where it's going. It is back in this previous consolidation zone here, but really I'm going to be looking at break of 303.44 on the dollar as the level to break before I turn necessarily bullish on the market, just because they're inversely correlated. And then if we look at yields, just a quick recap, the yields have basically collapsed completely. I was saying the yields were going to go a lot higher, but with all these banking crises, everyone had to rush to bonds, which I wouldn't be surprised if yields stay elevated low, because the market has a bad reaction to Powell. A lot of people are going to flood the bonds because they're already going that way, so they'll start moving more of their portfolios into here. The 1 year is resting right at its 200. The 2 year broke below the 200 daily. Next, going to the weekly. 5 year right sitting at the 50 weekly. 10 year just same story. All the yields are very in a bearish situation, and usually people flood to bonds when there's a lot of panic. And if we just look at TLT, which we've been covering for a long period of time, it's digesting this moving average of the 50 weekly and the 200 daily. So definitely kind of bouncing in between the kangaroo, as we called it, to then possibly get a break to the upside or downside. So we're going to have to be patient and wait for that. All right, guys. So we're going to go over the news for next week real quick before getting into the debate. So quickly going through it, on Monday, nothing really. You have a reserve balance with the Federal Reserve Bank, nothing really as a market mover there. On Tuesday, we have existing home sales coming in at 10 o'clock right after market open. I really don't see that being a huge market mover, just because it doesn't really fluctuate from its forecast. So you got to keep it in mind, but it's not necessarily the big daddy of the week. Then Wednesday, like I just mentioned, we have the big daddy of the week, the Federal Reserve interest rate decision with FOMC press conference. Everyone knows this. 2:30 on Wednesday is where we're going to get direction in the market. Really no big news on Wednesday. We have the initial jobless claims on Thursday, 4-week average, and the initial jobless claims. So I think Powell is going to move the market more than this. This is just going to kind of give you a continuation based off his speech and really what his intonation of the speech is. So if he mentions jobs, it may move the market. If he really glances over it, I don't see it moving the market at all. And then Friday, we have core durable goods. So if we have a set direction and the core durable goods go against that direction, you may see a slight pullback, but I think you would really see the market just ignore it. They're going to be hyper focused on Powell and the banks. And then, as always, net speculative positions. So with that, guys, we're going to dive into the debate section of the video. We're going to go over the Fear and Greed Index, summary of economic projections, and kind of give you a general thought process of where we see the next week happening. We're really going to focus on the FOMC and Powell. So with that, let's dive in. All right, so let's start off with the Fear and Greed Index. So we ended at 25. Did you think we would end here at 25 during the week?
You want to know something? Well, to be fair, it was a surprise that we went from greed to extreme fear in the span of just a couple days. Like, that was just absolutely insane. The fact that we are like right at the borderline between fear and extreme fear is a little bit, I don't know, it's weird, because it's like everything's going to depend next week, right? Because like we got the ECB decision this past week, and it really didn't do much. It really did not do much, at least here. Like, well, it brought the markets up, but they decided to do a 50 basis point increase anyway. So it's like, you know, you would think that with a 50 basis point increase on the ECB for Europe, it would crash the markets. Yeah, it didn't. So I think, I have no idea why that went up.
Well, here's the counterpoint for that. So you have turmoil in the markets, right? So the history shows, and people are a little educated of history, that the Fed or ECB, whichever central bank you want to put here, they always tighten till something breaks. So something's breaking when they pivot. And, the market front runs it and then crashes afterwards. History has repeated itself so many times in that. With all the turmoil and the hyper focus on the central banks, if they didn't raise interest rates at the expectations and then cited that it's because of X, Y, and Z, basically, Credit Suisse and all that, I think the market would have had a very, very poor reaction to it because it would confirm the fear in the market. It would basically say something's breaking. And because people have seen it so many times, you have the internet and everything showing the historical patterns of the market. Basically, they would confirm that something broke. Therefore, get your money out of the market. And it would just build on this fear.
I get that. And trust me, I fully understand that. But at the same time, it's like they've been calling for the pivot.
Yep.
Right? They have been calling for the pivot. So now, ECB raised interest rates by 50 basis points in Europe. Yet the market went up. So that can lead me to two options, I guess you could say. One of them being what you just said there, that if they needed to increase interest rates, because if they don't, then that means that there's something's broken. Therefore, they needed to do that. So in a way, they raised interest rates to stop the bleeding, which is backwards, completely backwards. But the second option would be that, actually, I guess it would be three options. The second option would be that because the ECB raised interest rates, actually, no, that wouldn't work either. Hang on a minute. No, I'm double thinking this again. The second option would be that essentially that they don't care about the ECB. They only care about the Fed. That's it. End of story. The Fed here in the United States.
So
it's just that simple. Like they do not care about the European Central Bank. They only care about what Jerome Powell says. That's it. End of story.
I do agree that I think. Well, here's my counter argument to that. In December, you had Powell come out and give a very walk the line speech, and then Christine Lagarde came out and basically, for all those that know who Christine Lagarde is, she's the head of the ECB. And basically said higher for longer, no pivot.
Of the ECB.
Yeah, she basically said higher for longer, no pivot, higher rates. She basically hammered the market, and the market, the January, December drop of 7%. So I think they do care, but it's what I saw driving the market this week is bank fears. The second bank fears got put back on the table, it just said, hello.
Even, by the way, even after the Swiss National Bank decided to give Credit Suisse a $54 billion bailout, even after that, it's still sold off.
Well, even FRC, if we actually pull up FRC real quick.
FRC is down 75%. I just looked at it, dude.
So let's take a look at this, right? So you have the banking SVB crisis. Yep. You bounce off Credit Suisse.
Yep.
You create more fear, bounce off Credit Suisse again, and you're right back to where you started. There's no mercy in this. Shareholders of this bank are basically saying BS to you, Fed. They're basically saying we don't care that all the depositors are backstopped. And just thinking about this, what did the one statement that came out of politicians' mouth this week? That shareholders should not be compensated for banks' losses, and that they won't be the Fed basically said that shareholders are going to be holding the bag. So
they're only bailing out the depositors, not the shareholders.
So here's the thing. If you are an investor, right? Let's put ourselves in the shoes of a heavily invested bank investor, because there's people that just invest in banks. There's entire portfolios built out of that.
I mean, let's just take Warren Buffett. Yeah. One of his biggest holdings is Bank of America.
Yeah, at 12.6% or something like that, or some ridiculous amount that he's allowed to hold of it. But regardless, that's the big six, right? But retail investors, they hear that, and they're just the first thing they're going to think is, oh my God, I'm going to lose everything. So let me sell. And then, the first person sell, the second person sell. It just never ends. And with FRC, it's okay, well, shareholders, you have zero hope of a bailout. The Fed basically said, like, yeah, you're on your own. So congratulations, you did the smart decision and sold. You basically said, I'm going to take risk off the table. And you're almost, would you agree they're almost calling the Fed's bluff?
I mean, again, that's absolutely like they've been calling the Fed's bluff, and then they do what they got to do, and then they can't beat the Fed. So yeah.
But like, do you, so like you've been calling about this since October. You said, and I remember this conversation fondly. You said the Fed is going to be stuck between a rock and a hard place.
Yep.
And I cannot imagine a harder rock and a harder hard place to be stuck between.
Yep. Absolutely. Because I mean, they literally have no choice. Either. Oh, also, here's something else too. So yesterday I did a video on Credit Suisse, like a quick rundown on the whole Credit Suisse thing.
Let's pull up
and going back to the whole ECB situation, they were like, oh yeah, like we're gonna raise interest rates 50 basis points. You know what they said right after that? But don't worry, we are here to inject liquidity into the banks if need be. I'm like, talk about taking half a step forward and then 50,000 steps back. The whole purpose of raising interest rates to begin with is to quell inflation. If they're going to raise interest rates 50 basis points, which by the way, again, that's 0.5%, to then just be like, don't worry, if anything happens, we're going to inject more money into the system, causing more inflation, making this 50 basis points nothing. What was the point of doing the 50 basis points to begin with? Like, I kid you not, they literally said that. They literally said that. And I'm reading this and I'm just like, what is this? What am I reading right now? So the Fed here in the United States is kind of like in the same situation. It's like, okay, well, actually, I would argue it's even worse because they have a reputation with '07. Yeah. Right? They have a reputation with '07 of the whole, the whole bailing out the banks, and then the whole, what do we call it? Wall Street. What was the thing that happened in 2012? The thing with Wall Street? The Wall Street takeover. I forgot what it's called.
Occupy Wall Street.
Oh. Occupy Wall Street. There you go. Occupy Wall Street stemmed out of that, of the whole bailing out the banks. So the Fed's got that in their history, but now they also have to deal with inflation. Luckily, I mean, it went down, so I guess they have a little bit more leeway as to like, oh no, it's okay. We may not have to because it's going down, but they have to deal with inflation. But at the same time, if they let the banking system collapse, then people are going to get mad about it, but if they inject liquidity, that's just going to make it even harder for them to quell inflation. So pick one.
Speaking of that,
right?
Let's jump over to the summary of economic projections real quick.
Yeah.
And this is, I've been mulling this over, of the Fed doesn't give a rat's butt about CPI or PPI. Like, they do pay attention to it. But if we look at PCE, we're nowhere, we're like nearly double their target. If we go to the last PCE report, the year-over-year number is 5.4 and the year-over-year core PCE is 4.7. If we dive over to the summary of economic projections, we'll notice we're on the high end of the 2022 targets. Last time I checked, it ain't 2022, it's 2023, and we're already 1 quarter in.
Yeah, so like we're 4.7 for the last one, and looking at the core PCE inflation is 3.2 to 3.7. So we are pretty much like one whole basis point away from target. So that's gonna be interesting. So again, what's the Fed going to do, right? What is the Fed going to do? Are they really going to pivot? The way that, by the way, the way that I think that they're going to start the pivoting process is in, I guess, 3 different ways, which, by the way, we already got the first one. The first one being the slowdown of the interest rate, right? So originally we're at 0.75, then we went down to 0.5, and then last time I believe was 0.25, right?
Yep.
That's phase 1. Phase 2. This thing just happened. Clearly something's breaking. So the next thing would be the pause. If we actually get a pause, or if we get any change in this right here, in this summary of economic projections, that would mean phase 2. And then phase 3 is when they're actually going to start cutting interest rates. And I mean cutting, going from the federal funds rate actually decreasing again. So that's what I think is going to happen, or to all of that. So yeah, it really just depends as to what happens when it comes to this.
Yep. And also, do you think with the transitory lie, I think it's still burning them on the inside. I still think
I don't know anymore.
Well,
I don't know.
We can.
I don't know,
you got
because
two scenarios, right? So the market's pricing in cuts already at the end of the year, which could lead to a very bad reaction, and that reaction is going to be key off the summary of economic projections, like you said. And what if you got two scenarios? You either get a change to this, it stays the same, or it increases. I don't think it increases. That's the very, very unlikely scenario. But I would attribute a larger percentage chance that this actually stays flat, that they don't change their targets, which would confirm, to your point, phase 2, which is the starting the pause. Maybe they increase 25 basis points and Powell says, okay, next meeting, we're going to pause.
Or maybe they'll say next meeting we'll consider the pause.
Which
right?
the market will take.
Oh, the market will rally. I'll
the
forget about
market,
it, buddy. The market will actually rally.
Yeah, but
we're gonna see probably like 10%. We'll probably get like a circuit breaker on the way up at that point because there's too much volatility going up. Imagine that.
So I could see. I really think that you get that if you have the federal funds rate change. If they say we're going to pause next meeting, but you don't change the terminal rate, I think the market's going to, I think you see like a bullish reaction from it. And then when the market comes to its senses, it's going to be like, oh, wait, that's not a pause.
What does the pause, oh, wait, they're pausing. Oh, great. But what does that actually mean? As you said, they're pausing because something is breaking. Yep. Or broken already. So yeah,
and the thing is,
we're kind of already. Yeah, go on.
It's really amazing how we had all this movement in the markets, the banks. I'm like, what will the Fed be able to quell the fear?
But at the same time, you also have inflation as well. See, that's the problem with this whole entire situation, is that the Fed right now, they have two mandates: jobs, right, keeping maximum employment,
which they're achieving.
Right, according to them, because there's more jobs available than people in the United States, therefore they're good, right? Just because people aren't taking them, they have no control over that. Yeah. Okay, fine, we'll give them that one. And then the second mandate, it is stable prices, which they don't have. So it's like, where in those two mandates does it say protect the banking system?
Neither.
Neither, right? Because at the end of the day, if we were in a true capitalist society, banks would be allowed to fail. And if the economy is strong, other banks would just replace it.
And just
unfortunately, that's not really the case.
Just one final thought on the whole banking thing and just giving a wrap up. I encourage everyone to watch Kevin O'Leary's interview on Hannity. Even though if you don't like Fox or politics, I highly recommend the interview because Kevin O'Leary is a very, very seasoned investor. He's done a lot of startups. The guy actually knows a lot about the system. And he gave a very interesting view. Why I say interesting. He is actually the victim of SVB's bad investments. He is a depositor in SVB. He has a lot of companies that had deposits in SVB. And his opinion shocked me. Because traditionally, everything's self-serving, right? So you would give an opinion of, they need to be the depositors need to be bailed out and this and that. Do you know what he said? He said that, no, this bank should be able to fail. It was a mismanagement nightmare that didn't account for economical stresses. And he's like, this bank should be able to fail. Every bank should be able to fail because what you're doing, and every company should be allowed to fail. And he said, what you're doing is giving bankers a free ticket to be reckless and absolutely just care about the share price because they don't have a fiduciary responsibility anymore to their depositors. They only have it to their investors.
It's the same thing I said in my Credit Suisse video. I said the reason why 2007 happened was because the banks were willy-nilly with their mortgage-backed securities. Don't get me wrong, they were. But that's not the reason why they were doing that. It was because they knew from the very beginning that if anything bad were to happen, they would get bailed out. So why do they care? It's the exact same thing, and we're literally seeing it again. Like, it's the exact same thing. They're taking away accountability from banks. And it even goes beyond banks. If you take away accountability from anything or anybody, you're going to get recklessness. You're going to get just people doing whatever the hell they want because there's no repercussions. There's nothing bad will happen. Who cares? I fully agree with that.
You get this. You get this craziness.
You get that. And you also get the massive influx of people buying into bonds right now, causing the yields to collapse.
Yep.
I believe the 6 month yield was like above 5% just a few weeks ago.
5.14 all the way down to 4.5.
Look at that. That's the 6 month?
Yep, that's the 6 month.
All of that's telling me, look at those engulfing candlesticks right there. Look at that massive big one, and then just green down, green down. Like, it's like the reason why like people are flocking into bonds right now, causing the yields to drop. Who are these people, right? When you usually buy into bonds, that means that you are not.
You're not expecting a return in the market. You're expecting
right. You're
downturn.
not expecting a return in the market. But here's also something as well. The Federal Reserve just started to increase their assets again. Their balance sheet is going up. So it may be that they're the ones buying these bonds.
Yeah, buying all the bad debt.
All the bad debts. They're buying all the bonds at break even when the banks bought it back in 2021 and 2020.
Yep.
That's what I think, anyways. I'm not fully certain, at what prices. Unfortunately, I have no way to know that for a certainty. But if I was betting, man, I bet you see the Fed's balance sheet increasing, and then you see bond yields going down, so bonds prices are going up. Yeah, I'd be willing to bet that they're the ones buying it.
Yep.
Meaning that they're no longer offshoring their balance sheet like they were supposed to do. So think about that. They broke their saying on the whole. We're going to offload the balance sheet, and now they're not. So the odds of them on Wednesday being like, we're not going to raise any more interest rates is pretty high.
Yep.
Yeah, I think so.
Final
thoughts? Anyways, yeah, no, my final thoughts is just that, I'm personally waiting until Wednesday because anything can happen up until Wednesday. If the market decides to run, then you handle that as you handle that. And if the market goes down, then you handle that the way you handle that. At the end of the day, we're here to make money. End of story. Yep. It doesn't matter if the market goes up or down. You can make money either way. So
it's like
that's all I gotta say.
Monday, just think of this: the market is a hot stove. You got to put your hand on the stove. Monday, Tuesday, and Wednesday till 2:30. Keyword 2:30, not 2 o'clock, yep. Guys. 2:30 when 2:30. Powell opens his mouth.
Because we have seen, even though the summary comes out, like even though like the it's not the minutes. The statements. There you go. Even though the statement comes out, Powell comes out at 2:30, and it doesn't matter what the statement says. Even if he's just repeating it word for word, they're still going to change based off of what intonation he says.
Oh yeah.
So
it's like insane, you always say, he moved the comma in his statement, so therefore bullishness.
Yeah, it's like the period has one space over to the right, therefore,
But you know what's scary, and this is gonna be my last words.
Sure.
No one has found a buyer for SVB yet. None of the banks want to touch it. It's kryptonite. I heard. And they're considering, and I cannot believe I'm about to say this, the FDIC is considering covering the losses of that bank for someone to buy it.
Oh, so not a bailout, but a bailout.
Yeah.
Not a bailout.
No. Because, the 08 bailout had a period at the end, and this one don't, so it's not a bailout.
This one has a semicolon.
Yeah.
Yeah, the sentence isn't over yet. But anyways, guys, I think that pretty much does it for this video. Like if you like, comment, subscribe. It really does help with the algorithm on YouTube. You guys can follow us on the new tech sites. Link in the description below. So with that said, peace out, and we'll see you all next time.